you got to know what comes next. Time now for some solutions to help you get back your financial life. Sue Hunt is with Consumer Credit Counseling Service. All right, well, we know that one of the big downfalls of foreclosure, of course, is what happens after, the taxes that can accrue. How does this happen?
Well, it's unfortunate that many people don't realize that if their lender takes a home through foreclosure or even through what's called a short sale, if the lender doesn't sell that house for as much as the loan is worth, that the consumer, the homeowner, can actually be liable for taxes on the amount of unearned income that happens when that sale occurs.
Wow, that's adding insult to injury.
It's a double whammy.
You can call a tax attorney, though, maybe, and can you get that rate lowered?
Well, there's a couple things that we might suggest that you do. Is, first of all, if you're facing foreclosure, never just walk away from that transaction. Even if that foreclosure happens, and even if there might be a tax liability, it's a good idea to check back with your lender to look over the paperwork to make sure that all those numbers were correct. And if there is a tax liability and the lender's not willing to work with you about it, then certainly if you can't work directly with the IRS, give a tax attorney in your area a call.
Okay.
They'll be able to look over the paperwork.
All right, Sue.
And maybe give you advice.
Okay, well, let's talk about your credit score, because that's another big hangover.
Right.
How long does a foreclosure affect your credit score?
Foreclosures usually stay on your credit report 7 years. So
That's
anybody looking at your report, it is a long time.
Not as bad as bankruptcy, which is 10, but not good anyway. Let's talk about getting another loan, because I know people will probably go out and rent for a while, but they'll be eager to get back in a house. When can you do that?
We recommend that the homeowner stay away from any new loans for at least 12 to 18 months. The first and most important thing the homeowner can do during that length of time is to take a look at their credit reports and to work to improve their credit score, which has probably been pretty badly damaged.
Yeah, you bet. Okay, well, let's talk about, you know, some people think if I close some of my credit cards, it'll help, but not necessarily, right?
Not necessarily. Generally speaking, everybody should have somewhere around 4 to 5 credit accounts on their credit report that are in good standing. If you have less than that, it can hurt your credit score, and if you have more than that, it can hurt your credit score.
Yeah, there's no reason to go out and open a bunch of credit cards, that's for darn sure. Okay, let's talk a little bit about the relationship with foreclosure and credit cards, because it seems like the credit card issuers know all about you. Will they jack up your rate after foreclosure?
It's not unusual for your credit card companies to look at your credit report every couple of years, and if they see a blip on your credit report like a foreclosure, it is often the case that they will increase the interest rate on your cards.
Wow, that's not good news. Sue Hunt, thank you for helping us out. Lots of great information as always.